Hey, good afternoon, everybody. Welcome to MarketStream.live and Strategy Now on the last day of trading here in March 31st. My name is Joseph Cusick from the Cusick Group, securities offered by Money Block. And, I got a lot of emails pertaining to some discussions that we had this morning in the emerging markets and specifically in China and Japan. And they asked, well, you get all this data, you start to develop some opinions. I mean, how strategically do you start looking at this stuff? I mean, what are you drilling all this stuff down to? And how can I do it when I have an opinion and a fixed risk, kind of fixed return type of mentality? Well, I said, I'm going to actually talk about EEM then, the emerging markets piece. And so I want to jump into that, but before I do, just quick midday market update. Dow Jones down 17 at 20,711, still basically caught in that battle zone that we call it between the 20 and 50-day moving average. The S&P 500 is basically flat, up 80 cents at 2,368.80. NASDAQ is up 850 at 5448.30. Russell 2000 has been really the strongest one of the bunch in terms of leadership and move to the upside, up $6.69 at 1389.04. And we see that the volatility index, this has been very interesting. We talked about this morning on the open. Vol popped. It's really trading up. It's coming off of its highest levels, but trading at 1220, up 70 cents. So we have some volatility in the market. So what I wanted to do was kind of take a step back. Now, we've talked about doing different types of strategies in Strategy Now. And I want to kind of look at a setup now. And we reported this morning China had some decent numbers out as far as their growth targets were up. But we had mixed data out of Japan. And we also have property and financial names in Hong Kong down to mixed as well. So I thought, well, why not take a look at a general market ETF, EEM, and that is the iShares that looks at all the emerging markets. And they're really the primary holdings in the top 10 in the EEM are they are right now a lot of Japanese and Chinese stocks, currently trading down 21 cents today, and it's trading at 39.46. Now, when I look at this picture, I see a couple things. One is that the market's been trending up this year, but in a consolidation. It really doesn't have conviction after this initial trend to the upside. And if I can even scroll out a little bit more, you can see that basically over the last 6 months, since the December, let's say even the last 4 months, it has been just trending to the upside, challenged its 20-day, bounced back up, and now it's in this area where, it consolidated and now it's re-challenging its 20-day moving average. So maybe I was watching the overnight action report and I thought, well, you know what, I'm kind of getting maybe a little bearish. Not super bearish in Asia and the emerging markets maybe in general. So with that being said, how do I actually put a position on that I can optimize my sentiments? In this case, I might be getting slightly bearish. The market's pulling back the last couple of sessions, and you see it pulled back and then consolidated and it's pulling back again, but still bullish in terms of looking at it from a technical perspective. But fundamentally, maybe I just might think that this is going to need to be challenged a little bit. And I'm looking for something that would take advantage of some pullback, maybe into the area of testing that 50-day moving average, right? So I'm looking for an opportunity to do that. Well, one way that you can do that is with a bear put spread. Now, we've talked about bear put spreads in the past, but now that I've set it up, and I'm going to open up my virtual account so that you can take a look. And what I want to do is I want to set up something in EEM so that we have a sentiment. Remember, right, we look at the overall market sentiment, and we see that it's relatively bullish still. It's still bullish on EEM. But it's been pulling back in the short term and could be challenging critical levels that need to be held, and if broken, could put a short-term bearish sentiment on. Now, one thing that's notable is that we could actually take a look in the charts of EEM, And let's take a look at where the volatility charts are looking like. Because the one thing about EEM is that its volatility rank is still relatively low. And if we put in EEM, you're going to see that the green line, which is the implied volatility, is down here. Now, if I get rid of the stock price, which is the red line, you're going to see that the green line and the blue line is historic volatility and the green line is implied volatility. It's basically on its lows, right? It's roughly up. Maybe if I look down here, it's probably slightly higher than its 52-week low. And you see the low is right around 11. It's trading at around 12. So you can see it is an IV rank of around 16% for over the last 52 weeks. So it's relatively inexpensive. So if I want to set up a trade and I'm slightly bearish, I'm going to look to take advantage of that sentiment, but I want to make sure that if I'm going to use options, and then specifically if I'm going to be buying options, like for example puts, if I'm bearish, I want to offset the time decay risk, maybe implied volatility risk. In this case, it's very low, so I'm buying low implied volatility. Maybe I also directional risk. What happens if the market turns? I want to try to mitigate as much of that as possible. So what I'm going to do is I'm going to set up a put spread. So I'm going to scroll down. I'm going to take a look at options. And now I want options that expire roughly around 45 days left to expiration. Give me time to be right. Now, May 5th, we're already in the 30 days till expiration cycle. May 12th, right in the sweet spot. That's 42 days left to expiration. And as a matter of fact, I can take a look at this. And with the stock trading at roughly around 39.5, right? We see it's trading around 39.45, okay? I scroll down. The at the monies are going to be the 39.50s. And I want to be more conservative, so I'm going to actually buy the $40 puts. And now to offset that purchase price of $1.13, I'm going to sell, I could do the 38.5, maybe even the 38s. And I think I'm going to do the 37.5 because I want to give myself a little bit more profit potential. And remember, I saw support coming in at that 50-day moving average, which is right around 38 and some change. If it actually challenges that level, that could be a great opportunity for me to potentially pull off profits before expiration. Now, with that being said, I'm buying this at 113. I'm selling this at 26 cents. If you scroll up, you'll see that the trade is set up here. And let's say that I'm going to do, so my risk is, since I'm paying a debit, right? This is a debit spread. I'm buying the 40 puts. I'm selling the 37.5 puts. That's a 2.5 point spread. And for that, I'm going to have to pay somewhere around 87 cents if I was going to sell on the bid and buy on the offer. I could also work an order. Let's say somewhere around 85 cents. All right, 85 cents then would be my total risk, or $85 per contract. If I buy two of these, that would be $170. Now I have a $20,000 account, or at least available funds. So if I wanted to use a percentage of that, let's say 2%, I could actually do, let's do 5 contracts. Okay, and I'm going to do this for a limit price, debit, 0.85. And again, this is for example purposes only. I want to show you how I could put a fixed risk, fixed return, how I can work a limit order based on my interpretation of the market because of volatility, market direction, as well as forecast. One thing that we didn't do is we didn't forecast what the potential move is, let's just say going into expiration next week. And remember, a quick way to do that is the straddle strangle market. All you have to do is basically take the at the money call and put and add the offers. So 31 cents and 25 cents. So right there, you're looking at 56 cents. And then 12 cents on the first out of money strike put, right? So now you're looking at 68 plus the first out of the money strike call. So that's 72. You divide that by 2. You're basically looking at a 45 cent move being priced in either up or down in EEM going into the expiration cycle next week, end of Friday. So we review this order. Now that's with a 50% probability. Now, basically what I'm saying here is that I'm slightly bearish on EEM, right? Based on my opinion, whatever reasons other than the charts and other fundamentals that I looked at and heard about and studied, right? Again, this is just an example of how to put a fixed risk type of opportunity on if you're slightly bearish, volatility is relatively low, and you want to have time on your side. This is a nice strategy to deploy. So I'm buying the 40 puts, selling the 37.5 puts. I'm going to pay 85 cents per contract. I'm going to buy 5 contracts, so that means that 5 times 85, basically I have roughly around, about almost $550, $425, excuse me, of potential risk. And now you can see how I will work the order. If the market comes down and hits my offer, I'm filled. Otherwise, I may deploy it the next day. All right, folks. That's how you can deploy a bearish put spread in this situation where you saw some fundamental data that might come out that's mixed, slightly bearish. You see some technical information that shows that it might be slightly bearish over a shorter period of time, let's say over the next 20 to 40 days. And you wanted to put a fixed risk, fixed type of return opportunity out there. This bear put spread is a wonderful strategy to do in a low implied volatility market. All right, folks, that's it right now. We will be back with Tech Talk at 3:30 Eastern Time. I'm going to go over some names that could be on the move, and we're going to look at charts and options and give you that forecast. See you then here at MarketStream.live.